You're finally ready to invest. You want to buy hundreds of companies with a single click. But two options appear on the screen: ETF and mutual fund. One could save you tens of thousands of dollars over your lifetime. Do you know which one it is? In our last episode, we learned the golden rule of investing. Don't put all your eggs in one basket. We called this diversification. It's the single best way to protect yourself from catastrophic loss. So you're ready. You've saved some money. You open an investment account. And suddenly, you're paralyzed. The screen is filled with a language you don't speak. Cryptic letters like VU, QQQ, FXAIX. It feels like you need a secret decoder ring just to get started. This moment of confusion, this analysis paralysis, is the wall that stops millions of people from ever building wealth. Today, we're going to tear down that wall. Consider the story of two friends, Amy and Chris. Both are 30 years old. Both have listened to our advice in episode 3 and want to invest in a diversified way. They each have $10,000 to start. Amy goes to her bank. An advisor recommends a popular, actively managed mutual fund that invests in large U.S. companies. It seems simple, professional. The advisor takes care of everything. Amy feels relieved. Chris, on the other hand, spends an afternoon doing some research. He finds a low-cost exchange-traded fund, or ETF, that invests in the very same large U.S. companies. He buys it himself through a simple online brokerage account. For the first few years, their investments perform almost identically. Both are happy. They are both diversified. They both feel smart. But a hidden force is at work. A tiny number in the fine print. Amy's mutual fund has an annual fee of 1%. Chris's ETF has a fee of just 0.04%. This tiny difference seems trivial. A rounding error. But they have both forgotten the lesson from our very first episode: the power of compounding works in reverse, too. The secret is this: both ETFs and mutual funds are the solution to our diversification problem. They are the baskets we talked about. They are both pools of money, gathered from thousands of investors, used to buy a huge collection of different investments. They are diversification in a box. So, what's the big deal? The big deal is that they are two very different kinds of boxes. They are different vehicles, built in different ways, with different rules of the road, and critically, different costs. Understanding this difference is the key that unlocks the door to intelligent, low-cost investing. Let's break it down with an analogy. A traditional mutual fund is like dining at a restaurant with a set menu. You place your order during the day, but the transaction only happens once, at the end of the day, after the kitchen closes. The price you pay is calculated at that closing time. The chef, who is the fund manager, has carefully selected all the ingredients. For that service, you pay a premium. An ETF, or exchange-traded fund, is like shopping at a giant supermarket. The market is open all day. You can walk in at 10 a.m. or 2 p.m., see the prices of every item changing in real time, and you can buy or sell instantly. The supermarket is simply the venue. You are in control. This analogy reveals the three critical differences. First, is how they trade. As we said, mutual funds price once per day, after the market closes. ETFs trade throughout the day on a stock exchange, just like a stock. Their prices go up and down with supply and demand. This gives you more flexibility, but for most long-term investors, it's not the most important difference. The second difference is accessibility. Mutual funds often require a minimum investment, sometimes $1,000 or more, to get started. But with an ETF, you can often start by buying just a single share, which might only cost $50 or $200. This makes ETFs incredibly accessible for people who are just beginning their investment journey. But the third difference is the most important of all. It's the one that cost Amy so much. Fees. Many mutual funds are actively managed. This means you are paying a team of expensive analysts and a fund manager, our chef, to actively pick and choose stocks they believe will beat the market. This research and trading costs money, which is passed on to you as a higher fee, called an expense ratio. Most ETFs, on the other hand, are passively managed. They don't try to be clever and beat the market. They simply aim to match the market's performance by tracking a specific index, like the S&P 500. There's no star manager to pay. It's all run by computers. The result, the fees are dramatically lower. Let's go back to Amy and Chris. Let's fast forward 30 years. Both started with $10,000 and added $500 a month. And let's assume both of their underlying investments earned a solid 8% average annual return. Chris, with his low-cost ETF, saw his money grow to about $780,000. A fantastic result. But Amy? That seemingly tiny 1% fee has been a constant drag on her returns. Year after year, it was quietly being skimmed off the top, money that was no longer there to compound and grow. Her final total? About $615,000. That tiny 1% fee cost her $165,000. It's one of the biggest and most easily avoided wealth-destroying traps in the financial world. So, which one is right for you? While some actively managed mutual funds do beat the market, studies consistently show that over the long term, the vast majority do not. Especially after their higher fees are taken into account. For most people, especially beginner investors, the mission is not to beat the market. The mission is to earn the market's return reliably and at the lowest possible cost, to let compounding do its work and outpace the inflation we learned about in episode 2. For that mission, a low-cost, broad market index ETF is one of the most powerful, accessible, and effective tools ever invented. You are buying the entire haystack, instead of trying to find the needle. You are admitting you can't predict the future, and choosing to own a piece of all possible futures instead. This is not settling. This is a sophisticated strategy. The world of investing is full of jargon designed to make you feel like you need an expert for everything. But you don't. You now understand the fundamental difference between the two most common investment vehicles on the planet. You have the knowledge to look at a fund, find its expense ratio, and decide for yourself if the cost is worth it. This is power. This is the moment you move from a passive observer to an active participant in your own financial future. Choosing the right tool is just as important as having the right strategy. The path to financial freedom becomes clearer when we can confidently choose the vehicles that will carry us there, without hidden costs weighing us down. Our mission is to tackle the financial questions you're actually asking. Let us know in the comments what practical challenges you're facing, and your idea could shape a future episode. Subscribe and join the conversation.